What if I told you that just a few words spoken in a quiet room high in the mountains of Wyoming could send shockwaves through the entire global economy? What if a single speech could wipe away years of fear, ignite billions in profits, and push stock markets to heights never seen before? It sounds like fiction, but that's exactly what just happened. At the Federal Reserve's annual conference in Jackson Hole, Fed Chair Jerome Powell stepped up to the podium. Investors around the world held their breaths. Then came the words no one was sure they'd hear. The Fed is ready to consider cutting interest rates, and not years from now, but soon, possibly as early as the September meeting. In that instant, markets went into overdrive. On Wall Street, the S&P 500 leapt higher, climbing back toward record territory. The Dow Jones Industrial Average exploded upward. In London, the FTSE 100 index surged to fresh all-time highs. Tokyo's Nikkei jumped. Frankfurt's DAX followed. Everywhere, investors hit the buy button in a frenzy of euphoria. But why? Why does the mere hint of cheaper money send markets into such a frenzy? Why can a simple shift in tone from the Fed unleash such chaos, such euphoria, and yes, such fear? To answer that, we need to understand the incredible power of the Federal Reserve and the high-stakes gamble Powell just triggered. The U.S. Federal Reserve is not just any bank. It's arguably the most powerful financial institution in the world. When the Fed raises interest rates, it deliberately pumps the brakes on the economy. Borrowing becomes expensive. Families hesitate to buy homes. Companies cut back investments. Higher rates slow the economy and tame inflation, but they also cast a chill over markets. By contrast, when the Fed cuts rates, everything changes. It's like opening the floodgates of money. Credit flows faster, mortgages get cheaper, corporations expand more aggressively, consumers spend more freely. Investors know that when money is cheap, stocks tend to soar, because bonds and savings accounts suddenly offer meager returns, pushing people into riskier assets in search of profit. In other words, low interest rates are jet fuel for markets. For the past 2 years, Americans have lived through the other side of that coin. As inflation spiked to 40-year highs, the Fed fought back with one of the most aggressive rate-hiking campaigns in modern history. Meeting after meeting, rates went up, a rapid climb from near zero to over 5%, the highest in 2 decades. Every Fed announcement brought anxiety. Every increase made the cost of money higher, cooling the economy and punishing speculation. It was painful medicine, but it worked to slowly choke off inflation. Fear ruled the markets during this inflation fight. High rates made investors cautious and crushed many stock market darlings. Now, however, the game is suddenly shifting. Powell's signal in Jackson Hole suggests the war on inflation may finally be ending. With price pressures easing and the economy softening, the Fed is opening the door to a new era of easier money. And markets know this playbook by heart. They've seen it before. In 2008, amid a global financial meltdown, the Fed slashed rates to near zero and unleashed unprecedented stimulus. The result? After the initial panic, stocks began a decade-long bull market that created enormous wealth. The S&P 500 more than doubled from its 2009 lows over the next 6 years, fueled in no small part by the Fed's easy money policies. In 2020, when the pandemic brought the world to a standstill, the Fed stepped in again. It cut rates to 0% in March 2020 and pumped trillions of dollars of liquidity into the system. The stock market, which had plunged 35% in a matter of weeks, suddenly found a bottom. Over the following year, stocks not only recovered, but skyrocketed to record highs, gaining an astonishing $22 trillion in value from the trough as the Fed's actions stabilized markets. It was a whiplash-inducing rally that defied the dire economic reality on Main Street, driven largely by the Fed making money virtually free to borrow. Investors today believe history is about to repeat itself. They see inflation finally coming under control and the Fed poised to pivot from tightening to easing. They don't want to miss the next big wave. The mere hint that rate cuts are coming has triggered a buying stampede, a rush to grab stocks before cheaper money floods in. It's classic FOMO, fear of missing out. If the Fed really is about to make money cheaper, savvy investors want to load up on assets now, anticipating that prices will only surge higher once the rate cuts actually arrive. Yet behind the celebration lurks a darker truth. Rate cuts are not free. They may create wealth, but they can also create illusions. They carry risks that can destroy just as easily as they create. Powell's few words have unleashed tremendous hope, but they have also set in motion a high-stakes gamble. When the Federal Reserve makes a move, it doesn't just affect America, it shakes the entire world. In today's hyper-connected markets, a single U.S. rate cut can send money sloshing across continents. Investors in search of higher returns might yank capital out of the U.S. and pour it into emerging markets, where interest rates are higher, or into commodities, or anywhere that offers a better yield. Capital flows reallocate globally. Suddenly, emerging economies see money rushing in, their currencies surge or swing wildly, and their governments scramble to adjust policies. Major stock indexes from London to Tokyo often jump in tandem with Wall Street, as global traders react within seconds to any Fed signal. It's a ripple effect, like an earthquake in the financial system radiating outward. And yet, it's not just about the money itself, it's about psychology. Markets are built on belief. Investors make bets not on what's happening today, but on what they think will happen tomorrow. That's why forward guidance from the Fed can have such an outsized impact. In Jackson Hole, Powell didn't actually cut rates. He didn't change any policy on the spot. He simply hinted that relief might be on the horizon, and that hint was enough to ignite a worldwide rally. Belief became a tangible force. Powell's cautious words turned into a conviction among traders that the era of high rates is ending. That conviction became momentum, and momentum poured billions of dollars into stocks overnight. Traders on the New York Stock Exchange floor amid a market rally. Powell's dovish hint at Jackson Hole sent stocks surging as investors rushed to buy. But here's the danger. What if investors are wrong? What if the Fed delays or changes its mind? What if Powell's hint was just that, a hint, not a promise, and the easy money doesn't materialize on schedule? The very psychology that builds euphoric rallies can flip into panicked sell-offs in a heartbeat. The same traders hitting buy in unison today could just as easily slam the sell button tomorrow, dumping stocks in a frenzy if they feel misled or spooked. History is filled with moments when misplaced optimism turned into devastating crashes. Think of the dot-com bubble of the late 1990s. Investors were drunk on optimism. Easy money was a big part of that story too, until reality struck and trillions of paper wealth evaporated. Or the housing bubble of the mid-2000s. Years of cheap credit fueled a frenzy of home buying and risk-taking, only for that bubble to burst in 2008, causing a global crisis. In both cases, the prevailing belief was, this time is different, until it wasn't. Easy money can create bubbles, and bubbles always eventually pop. Even officials within the Fed have acknowledged this risk. Critics during the last bull run warned that ultra-low rates could be inflating dangerous asset bubbles that might burst with disastrous consequences. Today's rally has been built not on concrete improvements in corporate earnings or economic productivity, but largely on the expectation of Fed rate cuts. It's a rally built on sentiment, on hope. And hope can be a very fragile foundation. If that foundation cracks, the fall could be brutal. As one market adage goes, markets climb on speculation and tumble on realization. If the realization is that the Fed isn't riding to the rescue as quickly as hoped, we could see a lot of this recent surge unwind violently. And the stakes now are enormous. Yes, cutting rates would likely jolt growth and prolong the market party, but it also risks reigniting inflation. If Powell cuts too soon and cheap money floods back in while the economy is still running hot, prices could start rising faster again. If inflation comes roaring back, it could undo all the progress of the past 2 years. Consumers would feel the pain of rising prices eroding their wages and savings. Businesses would face higher costs and potentially panicky financial conditions. The Fed would then be forced into an even tougher corner, perhaps having to hike rates all over again, even more aggressively, to finally slay the inflation dragon. In the 1970s, the Fed made this mistake. They eased up on interest rates prematurely, only to see inflation surge back stronger, forcing even more drastic rate hikes later. It turned into a vicious cycle that took a decade to break. Powell is keenly aware of that history. He does not want to be the one who lets the inflation genie out of the bottle again. On the other hand, if the Fed waits too long and keeps rates very high despite a weakening economy, there's a different set of risks. The economy could tip into a recession, unemployment could rise sharply, companies could cut investment and jobs, and the entire post-pandemic recovery could falter. High interest rates, if maintained past their due, can act like a sledgehammer on growth. Powell is effectively walking a tightrope, balancing on one side the risk of economic slowdown and on the other the risk of runaway inflation. And he's doing it with the entire world watching his every step. So the trillion-dollar question is this: are we witnessing the dawn of a new golden age? or the calm before the next storm. Every time the Fed pivots, there are winners and losers, and this time will be no exception. If Powell indeed pulls the trigger on rate cuts, certain players will emerge as clear winners. First, heavily indebted corporations and governments will breathe a sigh of relief. Over the past 2 years, many companies struggled under rising interest costs, like a homeowner with an adjustable mortgage watching their payments climb. A rate cut is effectively a financial pressure valve release. Their debt payments shrink, refinancing becomes cheaper, and their balance sheets suddenly look healthier. Some companies that might have teetered on the edge of bankruptcy under high rates could find a new lease on life. The technology sector would likely be another winner. Tech companies, especially high-growth startups and innovation-driven firms, thrive on cheap capital. These are businesses often valued on future earnings far out in the horizon. When rates fall, those future profits become much more valuable in today's terms, since investors aren't losing as much by waiting. It's no coincidence that the last decade's tech boom coincided with historically low interest rates. Cheap money made it easy to fund moonshot ideas and pushed investors into riskier, high-return sectors like tech. If the era of easy money returns, expect Silicon Valley and the Nasdaq to rejoice. Real estate, too, is desperate for relief. Think about the housing market. After years of rock-bottom mortgage rates, 2–3% fueling a housing frenzy, rates jumped past 7% in the inflation fight, and the property market went ice cold. Home sales plummeted, price growth stalled, and homeowners found it much harder to upgrade or move. A swing back down in interest rates could reignite the housing engine. Mortgages would become cheaper, bringing more buyers back into the market. Home builders and real estate developers, who have been sitting on the sidelines as borrowing costs skyrocketed, could start projects up again. Commercial real estate, which was hammered by high financing costs and lower pandemic-era demand, would also get a boost from cheaper loans. Even emerging markets stand to win in a Fed easing cycle. When U.S. rates drop, global investors often venture outward in search of better returns. Capital that fled emerging economies when the Fed was hiking, seeking the safety and yield of U.S. assets, may now rush back in. This can mean surging stock prices in places like India, Brazil, or South Africa, stronger local currencies, and a general economic uptick as investment flows in. For these countries, a Fed rate cut can feel like a fresh wind in their sails. Suddenly, their own central banks have more room to ease policy, and their companies find it easier to borrow money as global financing conditions loosen. But the losers in a rate cut scenario are just as real, even if they aren't as loud. Savers and anyone living on fixed income investments will feel the pain. Consider a retiree or a conservative investor who keeps money in savings accounts, CDs, or government bonds. Over the past year, those people finally enjoyed some decent low-risk returns. Bank accounts were paying 4 to 5%, and a one-year Treasury bill yielded around 5% for the first time in ages. If rates are slashed, those yields will evaporate. We could return to the scenario of recent years where a bank CD might pay 0.5% a year. Indeed, during the last easing cycle, some 5-year CDs offered barely 0.5%. That means retirees who rely on interest income could see their monthly earnings cut drastically, forcing them to either tighten their belts or venture into riskier assets, which many are uncomfortable doing. In short, savers get punished in a low-rate world. Their money earns almost nothing, especially once inflation is factored in. Another under-the-radar loser: anyone whose wealth isn't tied up in stocks or real estate. This is a broader societal effect. The Fed's low-interest policies in the past turbocharged the stock market, benefiting those who owned lots of stocks while doing relatively little for those who don't. The wealthy, who hold big stock portfolios, see their assets skyrocket, while working-class families with only small savings accounts see negligible gains. The result can be greater inequality. The rich get richer fast, while everyone else gains little or even falls behind if inflation eats their meager savings. This isn't a direct loser in the sense of an individual, but it's a societal cost that comes with unleashing cheap money. The little guy can get left behind in an easy money rally. And we can't forget foreign currencies and economies that might struggle in the wake of a dominant dollar. If U.S. rate cuts spark a big economic boom in America and a rally on Wall Street, global investors might pile into U.S. assets, stocks, real estate, etc., looking for gains. That requires buying dollars, which could strengthen the U.S. dollar's value. A stronger dollar makes other currencies relatively weaker. For example, if the dollar surges, currencies from the euro to the Indian rupee might depreciate in comparison. A strong dollar can hurt foreign economies by making their imports, often priced in dollars like oil, more expensive, and by pulling investments out of their markets. Some countries could see their own central banks pressured to cut rates or intervene to prevent their currency from sliding too much. In short, the Fed's move that lifts the US can indirectly push others down or at least create headaches abroad. For every fortune made in one corner of the globe, there's often another eroding elsewhere. That is the paradox of Powell's new signal. It inspires hope, but it also carries hidden costs and trade-offs. Because make no mistake, rate cuts are not a magic wand. They don't create real wealth or productivity out of thin air. They borrow from the future to make today feel better. It's a gamble, one that can pay off or backfire spectacularly. Powell's Fed is effectively betting that they can revive growth and keep inflation on a leash. It's a delicate balance. If they cut too early, inflation could roar back, bringing us back to the nightmare we thought we'd escaped and forcing even more aggressive pain later. But if they wait too long, the economy could needlessly stall. Unemployment could spike, and we'd suffer a downturn that perhaps could have been avoided. Either path carries danger. The coming months will reveal which risk the Fed chooses to take, or how it navigates between them. That's why every trader, every banker, every policymaker is now fixated on the same date on the calendar, the Fed's next meeting in September. It's being called the moment of truth. Will Powell follow through on the hint and actually cut rates, or will he hold off? Trillions of dollars in asset values could swing on that decision. In the futures markets, wagers on a September rate cut have skyrocketed. Immediately after Powell's Jackson Hole remarks, traders bumped the probability of a rate cut at the next meeting to around 85%. The collective bet is that Powell delivers on the dovish signal. If he does, the current market rally could turn into a full-blown melt-up, with stock indices potentially smashing through to new record highs. If he disappoints or hesitates, however, watch out. The reversal could be swift and violent, as this feverish optimism flips to gnawing fear. Markets could plummet, erasing weeks or months of gains in days. It's no exaggeration to say hundreds of billions, even trillions, of dollars are riding on what the Fed does next. Some even argue the future of the global economy in the near term hangs in the balance. A well-timed easing could extend the economic expansion worldwide, while a misjudgment either way, too early or too late, could trigger turmoil. So here we are, a single speech, a few carefully chosen words, and the entire world holds its breath. That is the power of the Federal Reserve. That is the power of Jerome Powell. With essentially a nod and a wink, he has sent finance ministries, trading desks, and boardrooms from New York to London to Tokyo into a frenzy of speculation and repositioning. But the real story isn't just what Powell said, it's what it means for you, for your savings, your investments, your future. Because at the end of the day, these sweeping market moves filter down to everyday life. The rate on your future mortgage or car loan, the health of the job market you work in, the value of your 401k or retirement fund. And here's an unsettling truth. Right now, markets aren't rising on hard facts like earnings or GDP growth. They're rising on belief, the belief that the Fed will make money cheaper and that everything will be all right because of it. Belief is a powerful force, but it can change in an instant. The crowd that's euphoric today can panic tomorrow. The only certainty is volatility and uncertainty. So I ask you, are we on the edge of a new golden era for investors, or standing at the precipice of another illusion? Is this rally the real deal? A prelude to years of prosperity fueled by just right monetary policy? Or is it a castle built on fragile hope, ready to crumble if the winds change? Let me know what you think in the comments below. Will Powell's gamble pay off, or are we celebrating too early? And if you want to stay ahead of whatever the Fed does next and how it could impact your portfolio, make sure to subscribe. Because the next decision out of Washington won't just move Wall Street, it could rewrite your financial future.